Hey, what's up you guys? Welcome back. So somebody in my last video asked me if I could do a video on LEAPS. Now I forget who it was and I'm too lazy to go look it up, but I thought it was a great idea, so let's do it. Now for those of you who don't know, LEAPS stands for Long-Term Equity Anticipation Security. So basically it's an options contract that is dated really far out in terms of the expiry date. So usually we're talking about like 2 years or more, and the name makes sense, right? You're anticipating the underlying stock to be a certain price a long time from now. So the advantage of buying a LEAP contract though, instead of a regular options contract, is that LEAPS have a lot lower risk. So remember how options work. So they expire at certain points, right? So they have an expiration date. So if the option expires and it's not in the money, then that means that the option expires worthless and you would lose 100% of what you put in. So if you hold an option to expiry, it has to be in the money by that time it expires, or else you lose everything, right? So the expiration date of a LEAP is so far out though that the option is going to be a little bit more expensive, but in return you have a lot of opportunities for the options to become in the money or more in the money if it's already in the money, and if it's out of the money then you have more opportunities for the stock to go up or down, right? If you're buying a put, then if the stock moves against you, then you have more opportunities so that you can wait it out. So you're not in a rush for the stock to move back in the direction that you want it to. So if you have no idea what I'm talking about, by the way, I made a beginner's video on options, so please go watch that video. I'll post a link to it somewhere, probably up here or down below in the description as well. So I'm just going to assume that you did watch that video already and you have a basic understanding of how options work. So this video is going to be more of like a part 2 to that video, right? It's going to be a little bit more in depth. So the way that today's video works is that I'm actually going to use a real life example of a LEAP position that I just picked up in Dropbox. So this video is going to come to you in 2 parts. Number 1, I'm going to explain why I decided to go long on Dropbox in the first place. But if you're not interested in my bullish thesis for Dropbox, you can jump to part 2 of the video, and I'll leave timestamps for that down below. So part 1 is going to be sort of my bullish thesis on Dropbox, and then part 2 is going to be the LEAPS part. So feel free to jump around this video. I know this video is going to be a little bit more segmented, but that's okay. So yeah, 2 parts. Let's jump in. As always, don't forget to get your free $30 when you sign up and invest your first $100 worth of crypto using ShakePay. And also, there's still the $10 bonus for Wealthsimple Trade if you prefer to just deal with stocks. And links for those are down below in the description as always. Now, with Dropbox, first of all, what is Dropbox for those of you who haven't heard of the company? Well, Dropbox provides cloud storage and document management software, and the company offers a platform that enables users to store and share files, videos, songs, spreadsheets, basically anything you want. So basically it's an app and website, and it works across all operating systems. So whether you're on mobile or you're on desktop, it'll work across all the different platforms, and they'll give you 2 gigabytes of free encrypted cloud storage for you to basically put anything you want as long as you set up an account with them first. And then if you need more space, you can always pay a monthly fee and get access to a much bigger space. So they also have plans for teams if you need cloud storage for business purposes. That comes with more business-oriented solutions. And on top of that, they own a business called HelloSign, which is a service that lets you sign legally binding documents online securely. With that being said though, the stock has not performed very well throughout the past, I don't know, like year or so, right? So if you look at a 1-year chart, the stock went from like $17 or $18 per share to around $22 per share, which is pretty bad considering how many other tech companies have seen more than a double up in stock price in the same time period. In fact, if you look back even further, you can see that the stock price has essentially stayed the exact same since October of 2018. I think it's up like 2% or something since then, which is basically nothing, right? So if you look at the blue line right here, and I think the reason for the poor stock performance though is because of the growth rate, and that is declining. So you can see from this chart that the compounded annual rate of growth, also known as CAGR, for the trailing 12 months has shrunk from 30% something, 30 something percent to just 21%. So at least for the latest fiscal year, they're expected to do less than 15% of growth according to Yahoo Finance. And I think that this highlights a fundamental problem with Dropbox as they're competing with some of the best players in the field. So I'm talking about cloud storage giants like Microsoft, which has OneDrive, and Google Drive, which obviously is owned by Google. So despite the negative news, however, I think that a lot of that has been priced into the stock already though. So I think that the current valuation of the company of Dropbox is actually making it sort of an intriguing potential buy. So according to Yahoo Finance, the forward PE on this company sits at about a 22. Now I've seen other sources put it closer to like a 24 or 25, but regardless, that's pretty low for a tech company. So at the end of the day, we're talking about a company that is still growing at double digits every year. And looking at the balance sheet though, I do think that the balance sheet is pretty underrated for what this company is given their valuation. So they have $1.2 billion of cash on their balance sheet and almost no debt by comparison. So keep in mind that the company is only worth like $9 billion in market cap and $1.2 billion of that is literally just cash on their balance sheet. And also they've generated almost $500 million of free cash flow in the trailing 12 months, as well as they beat earnings estimate every quarter for the past 12 months. So all in all, yes, the stock price has been kind of stagnating, but fundamentally speaking, a lot of things are actually moving in the correct direction for Dropbox, in my opinion. So I really like the stock price here in the low 20s per share, and potentially I think that this stock can easily break $40 per share in the medium to long term, assuming that the market as a whole doesn't crash. Now, one last thing I will bring up though is that a lot of people have been drawing parallels between Dropbox and Slack. So if you recall, Slack was recently acquired by Salesforce, and many people are wondering if the same thing will happen to Dropbox, where they might get acquired by a bigger company or something like that. My answer to that is that I can definitely see that happening, and I can definitely see that being a possibility. So this company is worth $9 billion, as I said, so it'll be pocket change for a bigger company in order to acquire them. So I've heard names like Oracle and ServiceNow being tossed around. I mean, it's just pure speculation at this point, so I wouldn't buy the stock for the hope that they're just going to get acquired or something, but I think that is definitely, again, a possibility, right? Now, onto my position in Dropbox LEAPS contracts. So I'm using RBC Direct Investing as a platform. Now, you don't have to use the same platform, but I actually do like the way that they show off the options here. So you can use whatever platform you like, and it'll be relatively similar. So for example, for Dropbox, you can select the expiration date here on the top left-hand corner. If you want LEAPS, you're going to have to go into 2022 or 2023 ones. But here are the ones that I bought though. So I bought the Jan 20, 2023 calls with a strike of $10, and I paid an average of $13.41 per option. Now I bought these options last week, so the price has changed slightly. Now with options though, you got to look at the bid and ask spread. So the quickest way I can explain it is that the ask is the best price that someone's willing to sell it for, and the bid is the best price that someone's willing to buy it for. So with stocks, the bid and ask price is generally very similar, so at least for stocks that are frequently traded, but with options the spread can be kind of high if not a lot of people are trading it, right? So that's what it means when people say that something has low liquidity, meaning that not that many people are trading it, so you might get a huge spread, right? So the easiest way that I can explain is that imagine that you're selling, I don't know, like this can of Spam or whatever, right? So I have a can of Spam right here, and everybody knows what it is, right? Everybody has a good idea of how much it should cost, so the price of it should be relatively the same everywhere. Now, whether you're buying or selling it, the price should be relatively similar, so the spread is kind of small. If you're trying to buy or sell something, for example, like, I don't know, something really obscure, like a gravity-fed spray gun, right? Which I actually have one right here. Hold on. So I'm talking about, I have this, I got this in the Amazon bundle, by the way. So yeah, so there might not be that many buyers or sellers for this type of stuff. So I don't know how I'm gonna get rid of this thing, to be honest, which means that, you know, if you're a seller, you might have to kind of lower the price a lot in order to find a buyer who might be willing to buy it, right? And if you're the buyer, you might have to pay more if you're willing to, if you're only trying to find like a few sellers. Anyways, the point is that when you're buying options, you should always look at the ask price, because that's what you're gonna pay when you're buying, right? Because remember, you're the buyer and the ask price is what the people are willing to sell it for. You always got to look at the bid and ask spread when you're buying options. That's just one thing that I want to point out. So for this option, you can see that the ask price is $13.70, but this is per option. And remember that options are sold in contracts. In each contract is 100 options. So you'll pay $13.70, like $1,370 per contract. So one other thing you'll notice is that I chose these options because they're really deep in the money, meaning that the strike price is much lower than the actual share price. This means that most of the value of the option is gonna be tied up in the intrinsic value part. So recall what that means, right? Intrinsic value is basically what you can get when you exercise the option right now, if you exercise the option. So for these ones, the strike is 10 and the shares are $22.16, at least at the time of making this video. Obviously, it'll be different by the time you watch this, but whatever the share price is, let's just assume that it's $22.16, which means that the options are worth the difference between the two, right? So the options are worth at least $12.16. If it was worth any less, well, then you could buy an option, exercise it, and then sell the shares, and then make arbitrage opportunity, right? Which is impossible. So that wouldn't make sense. It's not exactly selling for $12.16 though. I said it was selling for $13.70, right? And why is that the case? Well, then the extra $1.54, the difference between the two prices, is to account for the time the option has until expiry. So $12.16 is what you would pay for the option if you exercise it today, right? If it expired today. But notice that you have until January of 2023. So that time should be worth something. And that time is called the time premium, or that extra price that you have to pay is called the time premium, or sometimes it's just called the extrinsic value. So the longer the time, the more the premium will be, obviously, because the longer the time, the more opportunities you have for the stock to move in the desired direction. So the beauty of deep in the money options is that you're actually not going to lose that much money to time decay, because the expiration date is a long time away from now, and because you're deep in the money, most of the option is intrinsic, right? So most of the value of the option is in the intrinsic part, and the time premium is very small. It's a very small part of the total value of the option, so you're not going to lose that much to theta decay. So what this is going to do though, this is going to simulate owning the shares. If you think about what the difference between owning the shares and owning the deep in the money call is, well then it's actually not that big of a difference. So if the stock price goes up, the gain is going to get added to the intrinsic part of the value of the option, right? Because remember, the intrinsic part is calculated by taking the stock price and minusing what the strike price is. So if the stock price goes up and your strike price is going to stay the same, right? So then your gain is going to be on the intrinsic part of the stock of the option, sorry. It's going to track the movement of the stock very closely. So how closely though? Well, we actually have a metric for this, and that metric is called delta. So delta measures the correlation between the movement of the underlying stock versus the option. So that was a mouthful. So what does that mean, right? For example, if delta was 0.9%, or not percent, but 0.9 on as a ratio on a call option, the underlying stock is gonna, let's say it moves up 1%, well then your option is gonna move up 0.9%, right? So it's like the correlation between the stock price movement and the option price movement. So having a high delta, which you're gonna have if you buy a deep in the money call option, so having a high delta is gonna help you simulate owning the shares, because it's gonna behave kind of like the shares. So if you ever bought a call option and the stock price goes up, and you're wondering why like your option didn't move that much, well, it's because you're probably too far out of the money. You bought an out of the money option, and your delta is far too low. So checking back on the option that we just looked at, the one that I bought, you can see that the delta is 0.91. So that's pretty high actually. So that means that it's gonna move almost the exact same as the underlying stock. Okay, so with all that being said, why do we go through all this effort to simulate owning the shares instead of just buying the actual shares? Well, notice how I said that this is almost the exact same as owning 100 shares. Well, if we were to actually buy 100 shares of Dropbox at today's prices, it would cost you $22.16, right? $2,216. So if you were to take the stock price and multiply it by 100, right? Obviously, but one contract of this call option will only cost you $1,370. So if you're doing the math, it's about a 1 to 1.6-ish leverage. Which means that if you actually wanted to buy 100 shares or more of Dropbox, but you wanted to put up less money while maintaining the same sort of almost the same upside, well then this might be a great way to do it. So you're freeing up the difference between 22.16 and 13.70, right? So if you're doing the math, you're freeing up about $846 that you can use to invest in other things, right? You can use that money to invest in either more Dropbox options or shares, or you can just put it somewhere else. And the risk to this strategy is really not that much more than just owning the shares, right? Because they're so far outdated in the future. They don't expire for such a long time. It's almost like owning the shares. Anyways, I'm going to leave the video here. Hopefully you guys understood the explanation. Hopefully you guys found this video helpful. If you did, please hit the like button. It really helps out with the YouTube algorithm, and consider subscribing if you haven't already. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye!